Hi, Mr. Mortgage at ya. It's Wednesday the 16th of April out here in beautiful California, even though we're slipping into the ocean more and more every day. Today I'm going to show you Alt-A and subprime and the differences and the similarities. The Fed's nice enough to put up a beautiful website with Excel spreadsheets on the whole Alt-A and the whole subprime universe, so we can take a look and notice the differences and notice the similarities, and they're a lot closer than you think. As a matter of fact, the universe of Alt-A is a lot larger than the universe of subprime, which is a scary thing. Default rates are rising, and what is so similar, of course, are the original loan-to-values of these loans. I mean, given what's happening to real estate values in the bubble states, in the bubble regions, with the exotic loan types, most of these Alt-A are in a negative equity situation. We know now that negative equity is a leading contributor of loan default, not necessarily loan type. As a matter of fact, the Boston Fed has a great paper on it if you want to Google it. Boston Fed negative equity. It tells you all about it. So everyone's trying to chalk this up as a subprime thing. They still are. The CEOs of these companies now during their earnings are coming out and saying how they're 80% done with the subprime crisis. Okay, we might be. But the Alt-A crisis is much larger. It cuts across all socioeconomic boundaries. Alt-A loans, the average FICO scores are well over 700 in some of the most affluent cities in the nation. Negative equity is a real effect amongst all borrower types. As a matter of fact, the more affluent person with 200 grand in the bank and great credit might walk away from his home that he's upside down in by $200,000 much faster than the subprime borrower because he has the means, he has the credit score. The subprime borrower doesn't have the cash or the credit to go out and rent a home and has to fight for the roof over his head. So there's some real arguments to be made here that the Alt-A crisis is going to be much larger than the subprime crisis. The loans were much more exotic. Some of them, including the pay option arm, the balances actually go up every month. So every month that you don't make a $7,000 mortgage payment, you choose to make a $2,500 mortgage payment, your balance goes up $5,000 a month. That puts you in an even worse negative equity position. But let's go over here. These loans the Fed, these charts that the Fed gave us, let's look at the similarities and let's come up with our own educated guesses on what's next. And if there is another shoe to drop, and are these banks that are holding all the big subprime loans going to have to write or Alt-A loans rather, such as Lehman, going to have to write these things down further because of their similarities to subprime, what's happening with the values of real estate, and where all this looks to be going. Be back. Okay, there's your website, Federal Reserve Bank of New York. There's all your great Excel spreadsheets down there and all your data. And up here is the website address. You can write it down. Okay, here's spreadsheets. Subprime stats from December 2007. These numbers are still very valid. We're going to look at California because California, Florida, Arizona, Nevada, the bubble states, the subprime and Alt-A states, they still are true. These are subprime stats. Total housing units, 12 million. We know that. Not all of them have mortgages, remember. There's only 500,000 subprime loans, okay? So let's go over here. Most of them are owner-occupied, 471,000 of those 500,000, so very few non-owner-occupied or second homes. All right, so let's go down here and take a look. Percent of owner-occupied homes at least one late in the last 12 months, half of them, okay? 58.9% are currently okay with their payments, meaning 41% are currently late. 41% of all subprime loans are currently late. Okay, let's take a look. Variable rate loans, adjustables, 73%. Keep that in mind. Very important when comparing with Alt-A. When are they originated? 05, 06, 07. Most of them in 06, second most in 05, then third in 07. Keep in mind these are all 228s and 327s, meaning the most defaults we're going to get are going to be this year in 2008 going into 2009. Okay, half were full doc. Half were stated income. Everyone thinks all these are liar loans. That's not the case. 52% were full doc loans. Check this out. This is one just really irks me. 54.5% were cash out refinances. So Washington and everybody's talking about bailing out all these subprime borrowers for mortgage people, putting them in the wrong houses and the wrong loans. No. the subprime borrowers are already there, pulled all their cash out of their home. 54.5% of them did cash out refis, yanked all the cash out of their homes, and now we're bailing them out with their pockets lined with cash. That's the real story. The data is right here. The data do not lie. Credit score average 662. That's strong. Average combined loan to value of purchases 94.2%. That's a huge characteristic. These are all 100% loans on the purchase side. We know they yanked all the money out on the cash out refi side. Now let's take a look at Alt-A loan. Okay, here we go with Alt-A. Let's look at the similarities. Again, California, 12 million homes. However, 733,000 Alt-A loans versus 500,000 subprime. Big difference, 50% more loans. And the loan balances are bigger. The average subprime loan was in the $200,000, Alt-A's in the $400,000 range. That's big. That's a big difference. Look at this, number of non-owner occupied. Many more, much larger percentage. 20% are non-owner occupied, and on subprime only like 5%. Non-owner occupied loans have a much higher default rate inherently. Number of loans with current payments, 85.9%. That means they're 14.1% delinquent already. That's how subprime started a year ago, if you remember, about 14, 15%. Let's keep on going. Variable rate loans. Remember subprime was 73%? Alt-A 72%. Let's take a look when they reset. 07, 06, 05 are when these loans were done. The most in 06 with 38%, 05 comes second with 26%, but 07 is huge with 24%. These loans are primarily 3 to 5 years when they reset. 3 to 5 years for the 3-1s and 5-1s, and 2 to 4 years for the pay option arms. Okay, so that means 09 through 012, these loans are going to come busting through with their massive resets. And pay option arms, when they reset hard. Your payment doubles. There's nothing you can do, and you're in a serious negative equity position at the time it happens. Look at this. Percentage of loans with full doc, 16.8. That means 83.2% were liar loans, stated income. Again, look at this. Number of cash out, 45%. Versus 54% for subprime. Average loan balance, $445,000. Look at this. Average FICO score, 718. There's already 14.1% default rate across the Alt-A universe with a 718 credit score. And look at this, the most scary correlation of them all. 89.11% average combined loan to value on the purchase side of it. That's big. That means it's the same as subprime was 94%. That means we know when these loans originated, 05, 06, 07 with the heaviest in 06, 07. That means all these people are sitting in a negative equity position, or the average loan, because they were originated at 90% loan to value. That is really scary here, because we know now that negative equity is the largest contributor to loan default. Okay. So you just saw the differences between the universe of subprime and the universe of Alt-A. To me, they look awfully similar, and they're acting just like subprime loans did. A year ago, and there's 733,000 of them versus 500,000 of them, meaning we have a much bigger problem on our hands coming up soon. So there you go, from the Fed's own mouth. The Alt-A universe is 50% bigger in loan count and 100% bigger in dollar volume. The similarities in the universes are striking. The only thing difference is the FICO scores are a little bit higher on Alt-A loans, but we've proven now over the past 6 months to a year that FICO scores are not representative of future ability to repay, because over the past 5 years, people that owned a home could just pull cash out and pay their bills whenever they were going broke and buy themselves a FICO score. It's not a reliable indicator. We know that subprime loans now are defaulting at a rate, or Alt-A loans rather, are defaulting at a rate that subprime were a year ago at about 15%. Subprime loans are now at 40%. Chances are, with the original effective loan to values being on average about 90%, values dropping, and the most of the loans being attained in 06 and 07 and fewer in 05, that these people are underwater on their home, and the negative equity effect is a real thing across all borrower types, that these loans, this massive pool of loans, are in jeopardy of going into default. And everybody's trying to make this out to be a subprime problem, and it's not. The housing market cannot withstand these subprime loans doing what, or these Alt-A loans doing what the subprime loans did. This is an emergency. It needs to be addressed. No one's addressing it. Have a great day. I have a new website out, www.mrmortgage.typepad.com. Go check it out. I try to post some real interesting stuff, or so I'm told. If you like the video, please rate it high, and I'll be back at you soon. And don't believe the hype.